Mastering company financial experts. Financial ignorance kills operational excellence. Why is it essential to understand the company's current financial situation, and how does its financial standing impact the organization's ability to achieve operational excellence, drive efficiency, and optimize resource allocation? As I sat across from the CEO of company financial experts, I couldn't help but notice the worn look on his face. The weight of responsibility was palpable, and I could sense the desperation in his tone as he explained the struggles his company was facing. "We're hemorrhaging money," he said, "and I don't know how to stop the bleeding." It was clear that the company's financial situation was dire, and it was impacting every aspect of the organization. But as we dug deeper, I began to notice a more profound issue: the lack of connection among the team members. They were working in silos, each focused on their own tasks, but no one was looking at the bigger picture. The sense of camaraderie and shared purpose was missing, and it was stifling the company's ability to achieve operational excellence. I recalled a similar experience I had with a client in the past, where the team was so focused on individual goals that they forgot they were part of a larger whole. I realized that social connection is the glue that holds organizations together, and without it, even the most well-crafted strategies are doomed to fail. As we worked together to revamp the company's financial strategy, I emphasized the importance of building strong relationships among the team. We started by implementing regular team-building exercises, where employees could bond over shared experiences and develop a sense of trust and reliance on one another. It wasn't easy, and there were times when it felt like we were taking a step backward, but I knew that this was essential to creating a strong foundation for operational excellence. As the team began to gel, we turned our attention to the company's moral compass. It was clear that the financial struggles had led to a sense of desperation, and some employees were willing to do whatever it took to meet their targets, even if it meant compromising their values. I knew that this was a slippery slope, and we needed to establish a clear moral framework to guide our decisions. Together, we crafted a set of guiding principles that emphasized integrity, transparency, and accountability. We encouraged open communication and empowered employees to speak up when they saw something that didn't align with our values. It wasn't always comfortable, but I knew that this was the only way to build a strong, resilient organization. Throughout the process, I was struck by the power of subjective experience. As we worked together, I realized that each employee had their own unique perspective on the company's financial struggles. Some saw it as a threat to their job security, while others saw it as an opportunity to prove themselves. I knew that we needed to tap into these individual perspectives to create a collective sense of purpose. We started by conducting one-on-one interviews with each employee, asking them to share their fears, hopes, and dreams for the company. It was a time-consuming process, but it allowed us to tap into the collective psyche of the organization and understand what motivated and driven them. We used this information to craft a compelling narrative that resonated with everyone, and suddenly, the entire organization was working towards a common goal. As I looked around the conference room, I saw a team that was transformed. They were no longer individuals working in isolation. They were a cohesive unit, working together towards a shared vision. The company's financial struggles were still there, but they were no longer crippling. In fact, the team was now empowered to drive efficiency and optimize resource allocation in ways that I had never seen before. Throughout the process, I was struck by the sense of fulfillment that came from working with a team that was driven by a shared sense of purpose. I knew that this was the key to achieving operational excellence, and I was grateful to have been a part of the journey. As I left the office that day, I felt a sense of hope and optimism for the company's future. I knew that they still had a long way to go, but I was confident that they had the foundation in place to achieve greatness. To achieve operational excellence, it is crucial to have a comprehensive understanding of a company's current financial situation. A company's financial standing plays a vital role in determining its ability to drive efficiency, optimize resource allocation, and ultimately achieve operational excellence. Operational excellence is a term used to describe the ability of an organization to consistently deliver high-quality products and services while minimizing waste and maximizing efficiency. To achieve this, Organizations must have a deep understanding of their financial situation, including their income, expenses, assets, and liabilities. This understanding is crucial in identifying areas of inefficiency and opportunities for improvement. A company's financial standing has a direct impact on its ability to achieve operational excellence in several ways. Firstly, financial constraints can limit an organization's ability to invest in new technologies, processes, and personnel, which are essential for driving efficiency and reducing waste. Without sufficient financial resources, organizations may struggle to implement new systems, upgrade existing ones, or hire skilled personnel, ultimately hindering their ability to achieve operational excellence. Secondly, a company's financial standing affects its ability to allocate resources effectively. When an organization has a clear understanding of its financial situation, it can identify areas where resources are being wasted or misallocated, and make adjustments to optimize resource allocation. This ensures that resources are being used efficiently and effectively to drive business outcomes. Thirdly, a company's financial standing has a direct impact on its risk tolerance. Organizations with a stable financial situation are more likely to take calculated risks to drive innovation and improvement, whereas those with a precarious financial situation may be more risk-averse, limiting their ability to achieve operational excellence. Furthermore, a company's financial standing affects its ability to attract and retain top talent. When an organization has a strong financial situation, it is more attractive to top talent, who are essential for driving innovation and improvement. On the other hand, organizations with a weak financial situation may struggle to attract and retain top talent, ultimately hindering their ability to achieve operational excellence. In addition, a company's financial standing has a direct impact on its ability to form strategic partnerships and collaborations. Organizations with a strong financial situation are more attractive to potential partners, enabling them to form strategic partnerships that drive business outcomes. On the other hand, organizations with a weak financial situation may struggle to form partnerships, ultimately limiting their ability to achieve operational excellence. To achieve operational excellence, organizations must have a comprehensive understanding of their financial situation, including their 1. Revenue streams. Organizations must understand their revenue streams, including customer segments, pricing strategies, and sales channels. This understanding is crucial in identifying areas of inefficiency and opportunities for improvement. 2. Cost structure. Organizations must understand their cost structure, including fixed and variable costs, to identify areas where costs can be reduced or optimized. 3. Asset utilization. Organizations must understand their asset utilization, including equipment, property, and intellectual property, to identify areas where assets can be optimized or upgraded. 4. Liability structure. Organizations must understand their liability structure, including debt and equity, to identify areas where liabilities can be reduced or optimized. 5. Cash flow. Organizations must understand their cash flow, including accounts receivable, accounts payable, and inventory turnover, to identify areas where cash flow can be improved. 6. Return on investment. ROI. Organizations must understand their ROI, including ROI on investments, to identify areas where investments can be optimized or reallocated. 7. Economic value added. EVA. Organizations must understand their EVA, including the value created by their business activities, to identify areas where value can be created or destroyed. 8. Key performance indicators. KPIs. Organizations must understand their KPIs, including metrics such as customer satisfaction, lead time, and inventory turnover, to identify areas where performance can be improved. 9. Benchmarking. Organizations must understand their benchmarking, including industry benchmarks and best practices, to identify areas where performance can be improved. 10. Forecasting. Organizations must understand their forecasting, including sales, revenue, and expense forecasts, to identify areas where improvements can be made. In conclusion, a company's financial standing has a direct impact on its ability to achieve operational excellence, drive efficiency, and optimize resource allocation. To achieve operational excellence, organizations must have a comprehensive understanding of their financial situation, including their revenue streams, cost structure, asset utilization, liability structure, cash flow, ROI, EVA, KPIs, benchmarking, and forecasting. This understanding is crucial in identifying areas of inefficiency and opportunities for improvement, ultimately driving business outcomes.